Chile's central bank is dialing back its growth expectations for 2026, and at the same time, nudging its inflation forecast a little higher. It is a combination that makes the job of setting interest rates considerably more difficult. The bank trimmed its outlook for gross domestic product, that is the total value of everything the country produces, while lifting its inflation projection by a modest amount. Neither revision is dramatic on its own. Together, they signal that policymakers see a bumpier road ahead than they did before. To understand why this matters, it helps to know a little about Chile's economy. Chile is heavily tied to copper. The country is one of the world's largest producers, and when copper demand softens, as it has in parts of the global economy, Chile feels it. Slower global trade, tighter financial conditions, or domestic consumers who are not spending as freely as expected can all weigh on growth. Any one of those forces, or some combination, may be behind the bank's more cautious view. The inflation piece complicates things further. Chile's central bank spent the past few years in a cycle that will sound familiar to anyone who has followed global monetary policy. Prices surged. The bank raised interest rates aggressively to bring them down. Then, as inflation cooled, it began easing rates gradually. A slight upward revision to the inflation outlook now suggests the path back to the bank's target is not as smooth as it once appeared. That creates a classic policy dilemma. Cut rates to support a slowing economy, and you risk pushing prices higher. Hold rates elevated to keep inflation in check, and you risk making the slowdown worse. There is no clean answer. Central banks rarely face one. Chile's bank has a strong reputation for independence and careful, transparent communication. That reputation matters here. It means markets are likely to take these revised forecasts seriously and to watch closely for any shift in the tone of future policy statements. For investors following Latin American markets, this update fits into a wider pattern of uneven growth across the region. Chile's fortunes are closely tied to copper prices, the pace of global trade, and decisions made in Washington. Specifically, how quickly the US Federal Reserve moves on interest rates. A slower Fed easing cycle can keep the dollar stronger and financial conditions tighter for emerging markets like Chile. The practical takeaway: watch Chile's central bank communications in the months ahead. Any change in language around the timing or pace of rate adjustments will be the clearest signal of how policymakers are weighing slower growth against a stickier inflation picture. This briefing is brought to you by First Financial News. Clear daily coverage of the economy and markets at firstfinancialnews.com.